Hello, everyone. Welcome to the Financial Profit. I'm Victor Durganov, and today we're going to talk about Alphabet, aka Google. So the last time we discussed Alphabet, aka Google, it was around $172. So since then, the stock made a solid run of over 20% before the recent correction. So Google recently reported a mixed earnings announcement, and its stock dipped by about 12% from a high of roughly $210 to only about $185. So we witnessed an interesting pullback recently, and I think it was a solid buying opportunity. And I still believe that this is a buying opportunity in Google stock, here. So this decline appears to have provided an excellent buying opportunity, as Google's earnings report did not illustrate any considerable issues that would likely impact its earnings in the intermediate and longer term. Moreover, Google's growth and earnings potential remains strong due to its dominant market-leading position, and the company's stock appears cheap relative to other mega-cap tech stocks and other stocks in general. So let's take another look at this Google chart here. Now, we see that Alphabet had a substantial pullback of about 12% recently, as I just mentioned. This appears like a healthy correction, as Alphabet stock became considerably overbought around the $210 to $200, in the $210-$200 resistance range. Now, the technical pullback came close to closing the gap around $180, which suggests that we had a solid correction, a solid pullback, and it also shows us that the $185 to $180 support is a solid support level. Now, the 200-day moving average is slightly below the $180 price support range, which basically strengthens the support point even greater, which pretty much limits the downside risk in Google here. And we have a pretty strong probability to move back up to around $205 or $210 or even higher in the near term. So from a technical standpoint, Google's stock is a buy here. It's a buy the dip moment in my view. Now let's talk a little bit about Alphabet's recent earnings report. So Alphabet revenue miss was very minor. Basically, Alphabet reported a GAAP EPS of $2.15, which was a 2-cent beat. However, revenue came in at $96.5 billion, which was a minor miss of $170 million for Alphabet. Now, despite this quote disappointment, Google's search business posted a record over $54 billion in sales for this quarter. Now, we see this chart here. This is Google's search revenue, and we see a record quarter, basically a substantial increase of about 12-13% here from Google's search revenue a year ago. Now, other highlights include YouTube ad revenue increasing by 14%, which is very healthy. And of course, the star of the show, Google's cloud business expanded at a very healthy 30% growth rate. Now, I also want to point out that Google's cloud business has outperformed its rivals, Microsoft, Azure, and Amazon AWS recently, making it a real bright spot in Alphabet's business arsenal. Therefore, despite the slightly sales miss, Alphabet's core businesses remain in great shape. And now another point I really want to hammer down here is just how cheap Google has become now. So let's look at these earnings per share surprises versus the estimates. And we see that Alphabet is very accustomed to basically beating their EPS estimates. So despite missing revenues slightly, it still beat EPS estimates for last quarter. Now we have mild growth factored in for the next 12 months, for next year. Well, this year, I should say 2025, but there is a high probability that that Google can surpass these estimates. So basically, the market expects about $9 in EPS this year, but in my view, Google can probably earn about $9.50. Now, next year, the consensus estimate is $10.24, but Google can probably earn around $10.50 to even $11 per share next year in 2026. And this is really what we should be looking at, is Google's potential earnings per share in 2026, which in my view is going to be around $11. And not just in my view, but we have many estimates around 11. I would say that the $10 estimate or the 1024 estimate is lowballed now, and there's a higher probability that Google can see 1050 or $11 per share. Now, given that Google is around 180 here, and it can earn around $11 per share next year, this illustrates that Google may be trading at only about 16 times forward earnings here, which is very cheap for a dominant market leading company like Google. So let's just compare Google's PE ratio, forward PE ratio, to some of the other tech mega cap tech stocks. So for instance, Microsoft trades at about a 25 to a 27 forward PE. Apple trades at about a 27 to a 29 forward PE ratio. Amazon has a 28 to a 30 forward PE ratio. Now, Tesla's EPS range is very wide, so it trades at a 50 to a 90 forward PE ratio. NVIDIA also has a relatively wide range, so it trades at a 25 to about a 33 forward P ratio. Meta Platforms trades at about a 22 to a 25 forward P, and Broadcom trades at about a 27 to a 33 forward P. Now, if we compare all these price to earnings ratios to Alphabet's relatively low 16 to 18 forward P, we definitely see that that Alphabet is pretty much being mispriced here on a forward price to earnings ratio. So there's a high probability that Alphabet that stock price is basically irrationally low here. Now we can also do a PEG analysis, a price to earnings growth ratio, and I'm doing this relative to the forward earnings 2026. Basically, we're taking the forward PE ratio, 2020 ratio, and just dividing it by the projected forward EPS growth rate. So if we do this with Microsoft, we get a PEG ratio about a 1.8. Apple 2.4, Amazon is 1.5, Tesla trades at a relatively high 3 PEG. Now, NVIDIA has an abnormally low PEG ratio of 0.7, but that's because NVIDIA's earnings per share are expected to skyrocket, so this is a little bit skewed here. Meta has about a 1.7 forward P, Broadcom forward PEG. Broadcom has about a 1.5 forward PEG, but Alphabet's, it's really only about a 1 or about a 1.1, depending on which estimate we implement. So again, excluding NVIDIA, which has an abnormally low PEG ratio because of its rapid EPS expansion projections next year, Alphabet has the cheapest big tech PEG ratio of about 1.1. Now, this dynamic illustrates that Google's valuation is inexpensive relative to its earnings growth potential, certainly much cheaper than the other big tech companies. Now, Google also has the cheapest valuation on a forward PE basis. It's considerably lower than other mega cap tech stocks. This dynamic illustrates that Alphabet stock may have been pressed down too much lately, and it may be around an attractive long-term buy-in level now. Now, let's look at my price target chart here and my sales and earnings per share projection. So I'm projecting Google to increase sales by about 12% this year and about 12% next year, which is roughly in line with the mid to slightly higher end estimates on the street. So I'm not using any kind of outrageously high growth rates. On the contrary, I'm using relatively modest growth rates concerning revenue and concerning earnings per share. So sales growth I have coming down from 12% to 10% in 2027 and coming down to about 8% by 2030, which is modest in my view, but still this gets us to about 600 billion to maybe even above 600 billion or close to 630 billion in sales by 2030, which is very significant. Now, during this time frame, we will likely see earnings per share growth slightly higher than the revenue growth because Google will probably be implementing AI optimizations and other increasing profitability tactics to basically bring up its earnings and its profitability potential in future years. So we could expect around a 15 to about a 20% EPS growth rate, and that should take us to about 11 to 13 in EPS by 2026, 2027, to about 15 or 16 by 2028, and roughly $22 in EPS by 2030. Now, I'm also implementing a higher forward P ratio, of course, because the 16 to 18 forward P ratio appears too low. So we could see Google trading at about a 23 to a 25 forward P ratio in a base case scenario to a mildly higher P ratio, about 27 to 30 in a more bullish case scenario. But for the sake of keeping the estimates relatively modest, I'm just sticking to the 23 to the 25 forward P ratio range. And this illustrates that this combination of earnings growth and multiple expansion could take the stock to about 250 in 2025 this year, to around 300 next year, and to about 500 or 600 by 2029 to 2030. So Alphabet sales could increase to a relatively modest but healthy pace of low double to high single digits in future years. This dynamic could enable its earnings per share growth to expand to about 15 to 20% in future years. And like I just said before, we could also see Alphabet's depressed multiple expand to about 23 to 25 or higher in future years. Now, this powerful combination of healthy EPS growth and multiple expansion could enable Alphabet stock to rise considerably as we advance. Now, I also want to note that on Wall Street, the average price target for Alphabet stock is about $220 now, illustrating potential gain of about 20% in the next year or so. Now, my 1-year price target for Google's stock is slightly higher. It's at about $240 to $250, illustrating the potential for about a 30% gain in the next 12 months in a base case scenario. So this dynamic makes Alphabet's stock a solid intermediate and long-term buy, in my view. Now, so that's pretty much my report on Google. I expect another solid year in 2025 with a 12-month price target range of $240 to $250. Please comment on whether or not you agree with me. I also want to thank you for watching my report about Google. If you enjoyed watching my video, please click like, share, and subscribe. And you can also follow me, Victor Durganov, the Financial Prophet, at seekingalpha.com. Thank you very much for watching, and have a great day.